Hey everyone, it's October 30th. It's the day after my birthday. I want to thank each and every one of you. I got yesterday, I'm not kidding you. We had a webinar at noon and I got over 1,500 birthday wishes. So I want to thank each and every one of you from the bottom of my heart. It means a lot to me and it was my best birthday ever. And I really mean that from the bottom of my heart. So I want to thank each and every one of you. Thank you. Let's get into this morning's session. We just had the GDP come out. And the GDP, the expectations for the GDP were not that great. The consensus was 1.7 and the actual was 1.9. So we did better than expected, which is going to give Fed a harder time for lowering rates because the economy is growing better than expected, but much, much slower than President Trump was hoping it would be at over 3% and below the 2% target that the Fed set a couple of years back. Not too far below, and frankly, not too bad considering the trade war we're in. I mean, honestly, it could be a lot worse, and I believe we have to thank the Fed for this because them lowering rates has been substantially instrumental in keeping the GDP at this level. So this is better than expected. The overall stock market, I'll get into let me look at the S&P real quick. This is the SPY. It's the ETF that tracks the broad market. Now, you would expect with the GDP, I can't speak this morning. My dinner last night, birthday dinner last night must have been really good, right? Actually, I don't drink alcohol, but anyhow. So it looks like we're topping out here. It doesn't look like we're going to go much higher. I would expect that the GDP would cause the stock market, especially a better than expected GDP would cause the stock market to rally, but we're not seeing it, and we're not seeing it in the tech. Now, why am I talking about the tech? Because the tech has been leading the broad market, and if you look at the RSI, let me show you the RSI level. I used the 10-day RSI. The standard is 14-day. I used 10 days. If you look here, it went overbought just a few days ago right here when it made new highs. So it literally triggered new highs and it started backing off. And I believe, and I've been saying this for 3 weeks now, I believe we're going to come back down to the 50-day line. And here's the thing. Let me show you why. This is the mid caps. This is the Russell mid-caps. If you look at the mid-caps, they've been going really choppy. And if you look at the small caps, let me show you the small caps here. These ticker symbols, IWF, IF, they get mixed up. But if you look at the small caps right here, notice since the bulk of the trade war started, this is going back quite a bit, but if you look from January, and this is almost the entire year, we've been moving sideways, and we're almost at the top of this channel. And when we were down here, I said, it looks like the market's going to get really bullish till we get to the upper part of this channel. Let me reduce the time frame for you. And now it looks like we're almost there, and boom, we're overbought. And so now you have two things happening. Now you have the small caps putting that pressure back on the large caps, and you have technology right here. This is the top 100 tech stocks running out of steam. Also RSI overbought, and our RSI is not something you can just blow at and like a stochastic and cause it to go overbought. It's really tough to cause the RSI to go overbought. So it looks a little bit overbought right now. More importantly, as I mentioned yesterday, this is the put to call ratio. Stretched out to the bull side, looks like we're coming back down. And again, if you look at sentiment levels, let me show you some sentiment levels here. You will see that only 53% of stocks in the overall stock market are trading above the 200-day moving average. That's not a positive sign. And if you look at the S&P 500 still, you will see that 70% of stocks are trading above the 200-day moving average. Now, here's the interesting part. Take a look at this. Let me show you. This is scary. This is the S&P 500. This is 70% of stocks above the 200-day moving average. Let me show you something interesting. I want to change the settings for maximum impact. Can you guys tell I love doing this stuff? So take a look. Let's go back 5 years. Look at 5 years. That's a monthly, that's weekly data. Look at the highs and look at where we're at right now. Now let's look at 10 years. Wow, look at that. Look what happens when we hit that line every time. Backs away. Let's look at 20 years. Nothing changes. That's monthly data. This is fundamental data, and we're right here. And the Russell 2000, the small caps, are right there. Let me show you. Are right here. Doesn't look that bullish for the market. Now, is the stock market going to fall apart? I don't think so. I think we're just going to come back down. And if I show you, let me show you the futures here, just to give you a good idea of where I think things are going to go. It's really interesting that GDP came out, markets are flat. Really interesting. So I don't know how we got into grains, but I just want to show you some futures. All right, let's look at the cash. Cash is down a little bit. Yeah, better than expected data. Let me just make the charts. I like to look at line charts when I'm looking at sentiment, but I like to look at candlesticks when I'm looking at price data. Yeah, overbought. Probably going to, unless earnings are just amazing, going back down to the 50-day line. Now, I want to talk to you about Apple. Remember, Apple has the largest market cap of any stock. And we got, let's see here, earnings estimates. I want to show you something here. I know they're reporting this week. I just want to go over some numbers with you. Let's see. Yeah. So if you look over here, I want you to take a look at this. The surprise has been positive. Last 2 quarters by 3.8%. And the year-over-year growth has started to decline. So it looks to me, now, what do I know? What do I know about Apple, right? But it looks to me like price is peaking out ahead of earnings, and we're coming back down. And Apple has huge market cap. I mean, this thing has massive market cap. This is like half of the Russell 2000 in this one stock. So if Apple comes down, and it may, because China could be having an impact on their growth and production, you may see Apple fall back down to the 50-day line. Would it put it in a bearish phase? No, not really. But it may put Apple back to the 50-day line. So be careful, and keep your eye on Apple. So again, let's summarize. Sentiment, broad market, flat. Tethering on a bear market, S&P 500, runaway bull market. Why? Because of these stocks like Apple that have massive market cap. If you strip away all the apples and you look at the mid caps, I mean, look at this. It doesn't look all that great. Here, IWM. Yeah, this is 2,000 stocks. Is it looking really that bullish? No. And it's overbought. So again, I don't mean to ramble on, and I want to give you a little summary, but I'm not seeing a huge bull run developing here. That's the key. On the other hand, we may see a little upside from the bond market. Not as much as I thought, because GDP is better than expected. So it kind of puts the immediacy or the urgency to lower rates on the back burner. Because why do you need to lower rates if the expectation was 1.7 and the number is 1.9, right? But again, I think as the stock market begins to soften up a little bit, we're going to see a little upside in the bond market, which is oversold. And when bonds get oversold, bonds tend to be choppy. It tends to rally. So expect bonds to rally at least to the 142, 143 area. And if we break the 50-day on the S&P and move down to the 200-day, then we may see bonds rally to new highs. I'll talk to you tomorrow. I'll give you more earnings updates. And again, Thank you for making my birthday so special. I'll talk to you later, guys. Take care.